So hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday, the 16th of June, 2023. Let me just type in hello traders into the chat box so that you can see where you can ask all your questions, if there are any. And yes, so I welcome you to today's Trading Spotlight webinar with a current, again, hot topic. We just had the release of the inflation data, in fact, 3 days ago. So on Tuesday, I'm coming in at 4%. And then things got interesting on Wednesday. Yeah, one day after with the FED. And why did they become interesting? Not because the FED paused during their her rate hike cycle, but because there was an adaptation in terms of the so-called dot plot on the upside. So the expected target rate at the end of the year 2023 is expected to be at 5.6%. So in a range between 5.5 to 5.75%. That's, very hawkish is probably a good way to put it. It's very hawkish, given that inflation on Tuesday came in at 4% at the lowest levels since March 2021, if I'm not mistaken. So inflation is cooling down. We have tensions in the banking sector. We've seen that. There were bank failures like Signature Bank, like Silicon Valley, like First Republic. We've seen that of the month of March, April. Still, the Fed thinks that it's necessary to keep on tightening. So 2 further rate hikes from the current level in the second half seem to be necessary, let's say. Well, and now the thing is getting really interesting because if you thought, especially given this run up, this bull run we've seen in equities, especially in the S&P 500, which broke to new yearly highs, and also the Nasdaq breaking to new yearly highs, and currently standing at the levels of March 2022, around 15,200 points. This is about to get ugly now for the bulls because they anticipated a more dovish stance. Well, no, this is not what we get to see. Instead, we are running higher, aggressively higher. And yesterday there was a massive short squeeze, and we want to put things into perspective. First of all, let me share the screen here at this point of the presentation. So if you're now watching this video as a recording on YouTube, please feel free to subscribe to the YouTube channel. Leave a thumb up here if you like what you will witness in the upcoming minutes. If you have any questions, not just for those witnessing here the event live, feel free to ask all your questions in the chat box below the video. So comment below and ask all your questions if there are any. And what we want to do is, yes, so first of all, we want to go through what is inflation, in fact, so that we are all on the same page. And then we want to put things into perspective. So what did we get to see, and what does it mean for the market in general? What can we expect in terms of the markets, especially probably the Nasdaq? That's probably, I think, the most interesting market right now due to the yield sensitivity. But, and this is very important, and here we have the risk disclaimer. Please make sure that you understand that we are focusing here, that we're talking about, and that we trade, if we make any trades, that we trade leverage products, which might not be suitable for all investors. So please feel free to check out the risk disclaimer on admiralmarkets.com for the full risk disclaimer. Understand the risks which are involved when trading leverage products. That you make sure you understand your risk profile, download the demo, see whether this product and the risk profile of CFD-FX products suits your risk profile. And if you're then willing to trade live, certainly you have the chance to do so. Reach out to Admirals for further details on this topic, especially on the risks involved when trading leverage products. if we play, or if you formulate any trade hypothesis right here in the webinar, now in the upcoming minutes, please make sure that you understand that what I present to you are my thoughts, and this is purely educational content. So don't think that this is kind of financial advice or something. It is not. It's purely educational. I share my thoughts. I give you an overview of where we stand right now in the market, what I think, what we can make out of this. But if you then plan to use my thoughts to formulate a trade hypothesis and make a trade yourself, please make sure that you understand that you're taking full responsibility and all risks involved when taking this trade, due to the fact that all I present here is purely educational. Short introduction to Admirals. In the industry for over 20 years now, licensed by the SISEC, FCA, ASIC, so around the globe, offices around the globe with a very, very competitive offering, not just when it comes to the NASDAQ, respectively the Qs trading, but also when it comes to the DAX, for example. Over here in Germany, we usually refer to Admirals as the DAX expert. So feel free to check out the website for further details on the offering from Admirals. One world, one broker, but our topic today is what is inflation and what can we make out of this. So first of all, a quick introduction into what this is, and then we'll jump into the price action itself, and want to focus on where we're currently standing, what to make out of the reaction to the inflation, especially to the Fed probably, and how to interpret this price action. Why do I say that the market is extended right now, risk reward wise? I have to admit, I'm not really willing to take the long side in this current environment, but you don't want to be short either. So looking at the squeeze we're currently seeing, and you have trouble from both sides. First of all, you want to get into the long trend. Great. That's probably a right side of the market right now, with looking at the chart coming from the lower left to the upper right. So it's obviously going up. But the problem is that it's kind of a curl up and kind of an extension, and there are not real pull-ins happening right now. No corrective moves. This is mainly due to the fact that the volatility index is very low. On the other hand, just imagine you are short for whatever reason. Just imagine you don't have a stop in place right now. You should never do this, but just imagine you're in the market right now, and now you see this curl up higher, and you just think, hey, guys, really, like, do I want to exit my position here? Since we are so extended, nearly vertical, I mean, there will be a pull-in. Hopefully there will for my short position, but you really have to feel like you're fighting with yourself. Like, I have to cut the losing position here due to not having a stop in place, which perfectly illustrates why you should always have a stop in place. But then on the other hand, you say, well, cutting here, risk reward wise, does it really make sense? Well, certainly it makes sense. Cutting your losses short, and you don't know how far the squeeze will go, but yeah, well, let's put it that way. If I found myself in such a position, I can be 100% sure in the past that when I exited the position several years ago, not having a stop in place and all that stuff, that it was the perfect top. And then from there, we just went into the right direction. So there's a perfect example right now why especially risk management and stop levels, hard stops have to be in place all the time and be respected. Else you find yourself in a very, very tough spot right now. For example, in this current environment. And by the way, I think we're somehow witnessing something we've seen in the past. That's around 3 years ago in 2020, when the COVID panic vanished, and there was this massive stimulus, and the market just rose higher and then accelerated on the upside with no real pulling in. And finally, there was kind of a, let's say, corrective move, when we can talk about this, around Labor Day. That was in September. So the bull run right now we are seeing here in the NASDAQ, especially with making new yearly highs, breaking above the August 2022 highs in NASDAQ, but also several weeks ago in the S&P 500. We are in the bull run now, and it's not sad that this will stop, but in fact, when looking back in 2020, we've seen that there was a massive acceleration on the upside, which is a very, very dangerous environment, especially for those trading anti-cyclically and planning to trade the short side here in the current environment. But it's too much right here, right now. We'll look at the charts in a few seconds. First of all, we want to focus here on inflation, what this is, what to make out of this. So first of all, what is inflation? So inflation in economics, inflation is a general increase in the prices of goods and services in an economy. And when the general price level rises, each unit of currency buys fewer goods and services. So this is exactly what we're currently witnessing after COVID and lockdowns and massive monetary stimulus, fiscal stimulus, monetary stimulus from central banks. There was fewer goods and more money, which chased these fewer goods. Prices went up. Everyone was surprised. Okay, not everyone, and I was only the politicians and central bankers around the globe which were surprised that this would happen. Probably, well, they didn't finish their 101 in economics in the university. I don't know. However, this is exactly what we're currently witnessing on a broad scale. And so the thing is, and this is what becomes clear here, inflation erodes the purchasing power of a bond's futures cash flow. So we are not only looking here at money buying goods, but also we are looking here at the bond market especially and the future cash flows. So and that's put this simply means that the current rate of inflation, the higher it is, and right now we are witnessing that it's coming down, while the higher the expected future rates of inflation, our expectation in terms of the inflation, the higher the yields will rise across the yield curve as investors will demand higher yield to compensate for inflation risks. And for the inflation, which is very interesting because now, as you have seen, and now we're coming to the next slide, and I took a screenshot here from Trading Economics. Let me, by the way, just check out here. Okay, one sec. I just have to boop, and then where's the link? There we go. So it's from Trading Economics. Let me share this. You can also find this information on the website, admirals.com. Let me just, Admiral Markets, there we go, .com. And there, check for the analytics Forex calendar tab. And there you can also find information. Let's go back here to Monday and then filter and high importance events this week. I checked some boxes here, for example, the United States, and there you can also see that on Tuesday we had the inflation data. So we have it also here. But the reason I'm using Trading Economics, let me shorten it up. It's TE now in the chat box, is because I can play some games with it. Let's say, for example, overlay it with another chart. As you can see here, it's also the producer prices. This is, by the way, also a data set which was released the day after, on the day of the FEDs. No one really talked about this, but we really see, well, I'm not saying deflationary spiral, but it's like prices are decelerating as really aggressively. So inflation comes down very aggressively. So you've seen that this top out last year. It was in July, I think. For June, numbers were released. Inflation was released at around 9%, 9.1%, if I'm not mistaken. And from there, we really rolled over and saw a massive drop in inflation. If you follow these webinars here very closely, you're not surprised because I mentioned this over and over again, and it's no surprise at all. And we could have seen things coming here when looking at the producer, the ISM, for example, and the paid prices component. It's kind of the CPI here has kind of a delay to the developments, and we've published or shown this chart over and over again in the past. And what I now want to do is here, I want to illustrate how aggressively this deceleration in inflation currently is, and what we are currently witnessing here in this regard. And so the thing is, this massive deceleration here on the downside. The interesting thing now is that this, again, coming back to the presentation probably, and this is the same chart, but going back here again, no, you might say, hey, look at the last bullet point you have here, or the last arrow. The higher the yields will rise across the yield curve as investors will demand higher yield to compensate for inflation risk. But now put it the other way around. Like say, well, that means when looking at here at this chart, this blue line, obviously inflation is coming down. So why do we need higher rates then? Isn't it that if inflation comes down, that yields should come down too? And the answer is a straightforward yes. Yes, this is exactly what we should expect. But, and there we come to the next slide here. But this is not what we got to see last Wednesday with the Fed. So what I have here is on the left, it's the Fed Watch tool. This is also available for free. And if you hear me talking or other market participants, well, let's just speak for me here. If I talk about market expectations, then I'm talking about what the futures market here in this regard is expecting in terms of the Fed Watch tool. So each column represents market participants, and they take data from the options market, and then they say, okay, looking at where we're currently standing and given the duration and the expiration, especially of this and that option and how it's priced, we can derive what market participants are expecting in terms of yields here in the future, so in the upcoming months. And so for the Fed meeting, and here given the target rate, the yield level from the Fed, so what they then do is, okay, what they say, well, currently we're standing at 500 to 525, and in July, for example, given what we're currently seeing in the options market and how options are priced, we see that around 75% of market participants right now are betting that there will be a 25 basis point rate hike. The same is true when looking, for example, or well, one rate hike. Let's say one rate hike. That's very important to point out. Once again, looking at what we're seeing here in July, 25 basis points. Okay, but do you really expect the Fed to hike rates, or a rhetoric in direction of hiking rates, if inflation obviously is coming down? No. Given what we are just here, what we are just talked about in this slide, the answer is no. Usually you don't expect the Fed to hike rates further if inflation cools down as it currently does. And the interesting thing now is, in fact, not what the market participants are expecting. So they expect a further 25 basis point rate hike, but why they expect this, that has especially to do with the rhetoric being used from the Fed, especially from Wednesday. And what did the Fed communicate? Here, the answer lies on the right side, the Fed dot plot. So this is a chart I put out of the so-called economic projections here. As you can see, a summary of economic projections, and it was released on June 14th, 2023. And as you can see here, in conjunction with the Federal Open Market Committee, FOMC meeting held on June 13th, 14th, meeting participants submitted their projections of the most likely outcomes for real gross domestic product, unemployment rate, and inflation for each year from 2023 to 2025. So there's some FOMC members voting on the rates level. They have all their view on the overall economy. And based on that, they say, well, we expect the rate level to be XYZ in the future, at the end of 2023 and the end of 2024, 25, and in the longer run. So now, again, inflation comes in, and you probably recall last month. Let me just go back here. Let me just see whether I still have this. 1 second, please. Does it work? Let me just see. So you can see this is what okay, no, that's not working. Just ignore. So there we go. That was from last month. It's 1 month ago. We can see that the market here, I'm sorry, I don't have this one here. But the market was expecting that the Fed will be 50 basis points lower on average, 50 basis points lower than the current target rate. So they expected rate cuts in the second half. also, let's say mainly due to, I would say, mainly due to what we've seen here in regards to the inflation and the obvious downturn we took there. And interesting enough, as you can see here, I'm sorry, let me just go again a little further. There we go. But interesting enough, the dots, which came in here at 500 to 525 3 months ago, they now came in 50 basis points higher. So inflation cools down while the Fed expects the levels, the rates to be higher at the end of the year than it expected rates to be here at the last meeting in March. And this is very surprising, and it's just not working with each other really well, because you say, well, that just doesn't make sense. I mean, inflation cools down. We have tensions in the banking sector, Silicon Valley Bank, Signature Bank. We've seen that. We have also, let's say, kind of, it's a weird recession. Let's say we are currently witnessing in the US with employment being very strong, continues to be really strong. We are I'm also having still some solid numbers coming in around retail sales, but still there's some companies which just reported earnings, like Walmart, like, for example, Target. But in addition to that, also companies focusing or markets focusing on home builders like Home Depot, for example, or Lowe's, for example. They are all saying, well, we kind of realize that there's a kind of a, how can we say that? It's like there's a change. There's a change in their behavior in terms of consumption. So it's like there is a recessionary tendency, let's say. That's somehow how you could interpret this. So no one is really sure, is this a recession or not? But like, there's some second guesses in terms of the overall health of the US economy. And given all that and combining that and inflation cooling down and having the target of bringing inflation back down to the target rate around 2%, it's very surprising to see the Fed then saying, hey, you know what? We expect rates to be 50 basis points higher here at the end of this year. And so that being said, well, brings us now to the question, what's currently going on and what can we make out of this? Because it's very interesting to see how the market reacts. Again, going here now to the chart, I just want to here have a look. This is, by the way, the Nasdaq on a 5-minute chart. It's very interesting now to look here at the pre-market. We are running higher. So this is a 5-minute chart. We are ripping higher. That was especially yesterday. Let me probably go back to the Fed here. So that was the Fed rate decision and what we made out of this. So this is the high, let's say. Let's call it the Fed day high here around this, probably a good way to put it. And so the interesting thing now was that probably starting with the daily chart, we went parabolic, let's say. So we broke out here out of this consolidation that was in early May, probably late April, early May. We broke higher and make new yearly highs, broke these highs here around August 2022, and nearly went vertical. So really pushing higher. And the question here is, where is this move coming from? What is this? So why are we that strong on the upside right now? My interpretation was market is expecting the Fed to cut rates in the second half due to the developments we see in the inflation. Obviously, the Fed is communicating the complete opposite. So saying, no, we continue to hike rates, even though inflation cools down. So now the question is doesn't the market believe what we're currently seeing here, communicated from the Fed? It's a good question, to be honest. I don't know. I really have no idea. But what I can say is that the market really looks really extended on the upside and is really about to see a sharper pull-in. But the trigger we had now And by the way, we were already very extended. And how do I measure extensions on the upside? Therefore, I really like to go here with, let me just check it out. Is a custom indicator? Most likely it's a Keltner. I'm not really sure. Can we get this here? Keltner? I hope so. 1 second, where we have it. But here, hopefully it works. Doesn't work. Okay, that's a little unfortunate. Let me just share my screen then. Let me just share my screen. So these are the cues, just that you get an idea on how I measure extension on the upside. So we are looking now at the cues. I wanna use the cues here as the ETF on the Nasdaq 100, because I also have volume here from the ETF market on the downside. And what I really like to do is working with these bands. So, and I only use this to illustrate, to give me an idea of, are we extended or aren't we extended? And what do we have with this Keltner channel here? So in blue, you can see an exponential moving average. It's the EMA 50. And in yellow, we have an upper band, a lower band, obviously. And this is calculated based on the ATR, the average true range. And I say, well, if we are 5 ATR in the Qs, the ATR here is currently around 7, I think, seven bucks, something like that. I'm not sure. Let me just see, or 8, something like that. ATR 22. Oh, it's 5? Really? That's interesting. Come down a little. Okay, it's 5. Only 5. I'm sorry. So has been higher. That was around 1 year ago. But came down, obviously. So, however, we have an ATR here, so around 5 USD. And then I say, okay, if we are 5 ATR, so 5 times 5, $25 above the EMA 22, show me the upper, respectively, 5 ATR below the EMA 50, show me the lower ATR. And as you can see, we're holding within this band. And now we're getting really, really, really extended on the upside, breaking out of, and breaking above here, this channel on the upside. Again, given the current environment in which we find ourselves. So again, very extended on the upside, run up. Let's say it's an expectation, it's an anticipation of a lower yield in the second half, and the Fed lowering rates. Let's say this is the trade we are currently witnessing here in this regard, whatever it might be. And we're really exploding on the upside. And then we see the Fed, and the Fed says, no rate cuts, but we keep on hiking rates. So the complete opposite. We know that the Qs are yield sensitive. So that means we expect yields to rise, thus tech stocks to be sold. Similar to what we witnessed, and the reason why we were in a way stronger bear trend over the course of the year 2022, after or with the very, very aggressive rate hike cycle from the Fed and these massive moves on the downside. And right now we're seeing exactly that. The Fed continues to hike, not as aggressive as over the course of the year 2022, but still continues, and we're going vertical. We're pushing continuously, we're pushing higher. And now you're standing here in this environment and saying, okay, what's going on? What is this? It doesn't really matter, to be honest, because what matters is that we're currently obviously long, and you don't want to be short this environment. I don't know what's going on here, but it reminds me to some extent of what happened over the course of the year 2022, especially if you look here at this move from the COVID panic lows, and then really with us going vertical, especially here in the late summer, late August back then. And then we had a final sharper pull-in. There were some pull-ins over this move higher, but all in all, it wasn't really like very aggressive, but the market continued higher. And so this environment, and by the way, let me just bring this chart back probably, and let's have a look back just to put things into perspective. We touched the upper Keltner channel back then. It was probably a slight breakout higher here, especially here at the end of August. There was this massive extension. But given what we're currently seeing, that's more extreme than back in 2022, if you ask me. So again, the question is, what's happening here? Why is the market chasing? Why is the market breaking out? Let's now come back to the probably 15-minute chart. So here where the Fed highs, we already initially flushed lower on the Fed, given the inflation release, in fact. And by the way, this was the day before. So is that true? Let me just see. 14th. No, it was here. It was here. 15th, 13th. That was the initial reaction. You see here, there was a bullish spike higher. We then sold and we were choppy. That was on the inflation date number. But initially we pushed higher for this very one reason. Inflation comes down. Well, Fed should be expected to come out dovish tomorrow. That was at least my interpretation here. So then the Fed comes out with the dot plot showing further rate hikes. We flush lower. We reverse. No further strength. We roll over. Europe markets don't really push higher on the news because also probably there was some fear around the ECB, probably also coming out more hawkish. And I think we can interpret the ECB as more hawkish too. And then we just ripped higher. We broke through these, let's call them Fed highs, and never looked back, but just kept on pushing higher, squeezed higher, 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 higher. As you can see here now, this is a very interesting price action right now. And in fact, I don't want to be short again, at least not now, but let's see how things develop now. So we just saw the market opening, Wall Street opening. You see in the pre-market, we are ripping above the highs from yesterday, pushing higher. But the interesting question now is, can we hold these highs? If we are sold here now and hold below the highs and the market rolls over, I think then things start to get interesting once, I'm not sure. Probably let's bring back the cues here once again. Let's have a look here. And then we'll use this level. Again, this is positively correlated. Take this out here. You can see there's other lines in the chart. I will explain them now. So the orange line is the volume weighted average price. Here, this first purple line is the price from the Fed. So it's the price which was on average paid from market participants after the Fed was released. So I'm anchoring it here to the Fed release. So this is a price we can find around 367. So that means like here, it's around the Fed highs. Yeah. Well, we can do it that way. We can say, okay, these were the Fed highs around here, 15,100. Let's see if we, oh, by the way, let me just do it that way. So probably slightly lower than that, probably 15,000. If we drop this level here in 1,000, and you can see there's lots of room now. So bulls are heavily in control. Still, we are very extended from this price. So let's say it's the average paid price and it's the fair value. So imagine you're a portfolio manager saying, hey, this is bullish for whatever reason, but I'm buying here. You don't want to chase up here. So the risk reward for the long side is getting very, very unattractive. So chances increase that we are probably seeing some kind of pull in, but let's see where we find support. So I'm not really sure if there will be a pull in. So yesterday there was never a pull in, but we continued to squeeze higher. Probably today there will be, probably down to 15,100, 15,050. But all in all, right here, you don't want to be short as of now, but you want to wait. You want to wait until there's a clear sign. Let's just go back here to the chart once again. Or at least I want to wait until there's a clear sign and buyers are not in control anymore. And how do I measure that intraday? Well, I think it's once we drop here this orange line and hold below that. So it's the average. It's the volume weighted average price, and once we drop and hold below, so right now it's 375 probably. I'm sorry, 372. So holding below 372, which is around the highs from yesterday, if we can hold here after 4 p.m. German time, so in around 25 minutes from now. So right now it's like this is not a big deal right here. So we're just finding a price and what the market is it long or is it short? But if we hold then below the highs from yesterday, probably we see kind of a pull-in, slow drift lower, and probably we'll find a support around 367 around the highs here. And then we'll see, can we hold these highs? Can we hold these highs? If we pull in further, well, probably that's it on the upside then, and the squeeze is over, and we are about to see a sharper pull-in. What do I mean with sharper pull-in? Well, sharper pull-in means something, especially after this massive run higher, something similar to what we've witnessed in September 2020 here. So you see there, so those would squeeze higher, and within one day, we came in from 12,400 to down 11,700. So that was a pull-in of 2.5–3%. As aggressive as the squeeze higher we've witnessed, as aggressive a move lower can happen here. But again, you need a clearer sign for that. You don't want to short here, just for the sake of shorting, because you say, well, risk wise long is unattractive, so I'm taking the short side. Because the market right here, it's not said that we're done. So you should be really careful here. And again, especially now, if we're now after the first 30 minutes of trading, let's say. So right now it's too early. But if we're now taking out here these highs at around 15,280 around on the upside, after an initial flush lower, or let's say we flush to, I don't know, the pre-market low, somewhere here, 15,000, what is this, 15,130 or something like that. And then from there, ripping, buyers stepping in, pushing us higher, and we're taking out the highs. Well, again, you don't want to be short. You just don't want to be short here. And this is especially true in the current environment, in which it's very difficult to interpret the price action. Again, let the market just, let's say, settle, come in now after the squeeze higher. Again, very surprising. I didn't see that coming. I was like on the short side, and there was clients asking me, hey, Jens, how do you trade the FED now? And I was like, yeah, well, I have the highs from the FED. So here, let's take two lines. And I say, well, you know what? This is my levels to watch. And once we break out, I take a position. And then I said, I added, well, and I favor a short side given what I just presented to you, thinking that once we drop 14,800 on the downside, I'm short, and I probably see a pull-in down to, let's go to the daily chart. Let's just here to this trend line probably. So if we break this low, that probably we're headed for 14,500, something like that. Pull-in of, well, whatever. And I never made the long side a topic. So that was what I told them. So it wasn't like, well, obviously, if you break out on the upside, we take the long side. But I don't want to be long in this environment. I don't really favor long engagements in this environment. And I think we are very extended on the upside, given the capital channel and all that stuff, rhetoric fundamentally. And then I'm sure once we drop and hold below that. Well, you can see, well, this never happened. We, in fact, broke, based on my thesis, I should have been long here. Probably after the initial flush, that wasn't a flush, that was like 2 points in the Qs or something like that. And then we just ripped higher, and we clearly held. If we go here to a 5-minute chart, you can clearly see that. We came in at 3:30 German time, Wall Street opens. Though there's 2 wicks on the downside. We never break lower, rip higher, break above this pre-market high. I'm sorry, not the pre-market high. I'm sorry, the FED high. And then we are holding here. So we're extended. We're clearly holding. So this is potentially a spot to really think about the long side here. And I was like, I looked at the chart, like, not seeing any further strength here. Not really. I don't want, okay, it's not short, but I'm not long. And then you just see the market ripping higher, and you're like, okay, well, probably, obviously, probably, we are obviously long. And the same is true for today. But again, if you want to be long, then I think it's a good thing to think about this. I think 15,250, and I can fully understand that it is clearly following the overall trend. But if you want to be short in this environment, be really careful and wait for a clear signal. So right now we see we potentially broke higher, we failed. The price action today is different from the price action yesterday. So we saw that we tested the waters on the downside and really were bought up immediately within 10 minutes, 5 minutes, 10 minutes here, and then ripped higher. Right here, so you see we are coming from very extended levels above the highs from yesterday, so gapping up higher if you want in the Qs, but now coming in. And that's now the question is, if we continue lower, probably there will be kind of a pull-in, but we are making a lower high. Then the things start to get interesting. And intraday, if we're holding below the volume-weighted average price, well, then things get really interesting, because then probably we're getting to see a strong downtrend on the downside and a corrective move. But you have to remember one important aspect here I'd like to make. On Monday, Wall Street is closed. So on Monday, Wall Street is, well, that can play out in two directions. But let's probably go here to the website and check out the company news. And then you can see here trading schedule for June. And I'll just click on that. I will share the script in the chat box. You can see here that on, do we have it here? Is it written there? Yeah, there's Monday, June 19th. It's Juneteenth. And it's a day where metals, respectively, also, this is EET, by the way, so Estonian time in this case. Well, US equities are closed. So DAX is not closed, but here the Dow Jones is closed, but also the S&P 500, the NASDAQ. So it's a bank holiday in the US. And given this bank holiday in the US, the thing is now, well, low volatility, bank holiday in the US. Do we really get to see some kind of aggressive selling now into the weekly close? I'm not sure what to say. To be honest, low volatility somehow leaves me kind of like, I don't really see a big drop on the downside. Then on the other hand, just imagine you're heavily long for whatever reason, and you just see this massive squeeze, and you know there's a prolonged read-in. I don't really know what will happen over the weekend. Probably I'm taking some chips off, and then this is the first dominoes, which is falling, and then there's a cascade of further sellers coming in and pushing us potentially lower. So this is something to keep an eye on and to keep in mind. All in all, what I can say so far is the character changed given what we've witnessed yesterday. So this is not really strong. Again, if we rip from here, this is like ultra bullish in my personal opinion, even though, again, the market is very, very extended. But if we continue to drop lower, probably there's a retest of 15,000 into the weekly close due to profit taking after this extension on the upside. And probably it's the beginning of a deeper pull-in. Probably you also want to take something short over the weekend and then expecting a gap down on next week and a potential retest here of this trend line on the downside. Even though I have to say, I don't really like this idea. Really, to be short, especially short-term short for a momentum drive on the downside, 14,500, 14,200. What I want to see is I want to see the Fed lows dropping, 14,800. As long as we are above that, given the environment and so many reasons to be short in this environment, I want to be honest. I don't want to be short here. I mean, that looks very, very, 100 points within minutes. So again, we are very extended. Let's see. Probably first target 15,130, 150 on the downside. If the profit taking continues, market participants start to get nervous. Well, then, things get really interesting. Again, this is also from a purely speculative, but sentiment perspective. You probably wonder, hey, why is this guy looking here at the VWAP? What is exactly that? Again, it's the average volume. I'm sorry, the volume weighted average price, that way around. I'm sorry. It tells you which price was paid from market participants. Today, so far, the orange line, 371.39. This is the Qs here in this case. Let's have a look here, because this is true volume at a stock exchange being executed right now. So now you have two other lines here. You have the purple lines. Let's take out the lower one. I take out the low one for a reason. I don't want to overcomplicate things here. Where it's come from, but it comes from it's anchored on last week's lows. After on Wednesday, we flushed lower and then ripped higher from there. But what's more interesting for me now is from a purely, let's call it psychological perspective. This line here, so you see this flattening out, the orange line. If you want, this is the 2-day VWAP. So it's the price which was on average paid from yesterday, the day following the Fed, and it comes in around 369. So that was the price. As long as we trade above that, the market participants on average, which bought yesterday, are still in the money. Once we drop, they're underwater. And then again, Juneteenth, prolonged weekend, profit taking, probably these market participants say, okay, well, then we're done. And they take some chips off. They start to sell. The next very important line in the sand, I think, here is this flat line, this purple line here, which is the price which was an average paid from market participants based on the Fed. So I anchor it here. You can see that there. So there's the anchor. You can see the dot there. So that's the price which was paid from the Fed. Many market participants looked at the Fed, especially after this rip higher yesterday. They are right now, all the market participants who bought this, for whatever reason, they bought it, they're right now in the money. The thing is now, same as here for this orange line, which flattens out at 369.50 around, 368.50. Same is true here for 367. Once we drop, they are underwater. Prolonged weekend. Do you really want to keep the position? And then there's like an avalanche of selling potentially hitting. And this is why then you see such red candles as we made the topic here. I think, where we go. This is then when you see, well, what just happened there? Why is this such a deep red candle? How can it be that it's such a huge selling after such a strong move higher? Well, because there's more and more market participants underwater given the average price they paid. And we have a clear overview of this when looking at this volume-weighted average price. So from a pure sentiment perspective, psychological perspective, these guys look at the price as we do, and they're underwater. Once they are underwater, well, they want to get rid of their positions, especially with prolonged weekend after such a run higher and so on and so forth. And then you start really to see a huge sell-off. And as you can see here, it wasn't that we stopped. So that was the first day. The second day, we opened 11,740 and we flushed as low as 11,100. So another 600 points from the highs here. That was 1,300. That was 10% within 2 days. Again, if the more time frames come together here, the more market participants are underwater based on their position, the higher the chance that there will be a huge drop lower. And this is right now how I look at the chart and how I look at the cues here. And let's just see. So right now, there's, again, huge selling so far. I think this is no surprise. I wouldn't be surprised either to see kind of a bounce here. So if we probably push as low as 369 or 68.50, we hope probably see a bounce, but no real strong bounce, holding below 370, holding below the average price, which was paid, volume-weighted average price for today. So this orange line, short continues, we drop this level, support breaks, continues lower. Next target, 367. We hold immediately, bounce, no real buying stepping in, rolling over, dropping, and we continue lower. This is what's right now in play, but let's see if this plays out that way. But this is how a trend develops then over the whole trading day, and how you can look at the chart from a volume perspective in this regard, and then draw conclusions out of where's the market right now standing. So right now, right here, only for today, market participants are underwater. They are not underwater from yesterday. They are not underwater from the Fed. But once we drop these levels, the orange line and the purple line in terms of the Qs, and then translating this into the NASDAQ here, once we drop these levels, well, then things start to get interesting. So yeah, around this level here. So this is around the level. It's around the pre-market lows, in fact, right here. Yeah, around 15,130. That's probably the reason I would say is our line in the sand, probably, yeah, slightly below that, probably 15,070. This is the Fed. So if we drop below that, things start to get interesting, and we are probably not yet done then from the downside. But again, right here, we are holding at least for some, and then let's just see if we hold now below the volume weighted average price and then taking it from there. So Again, I hope that was more trading based, but I hope if you witnessed the webinar that you see how inflation and then the Fed, especially one day later, how this affects the current bias in the market, and then especially looking at the price action and how to draw conclusions out of what we are currently seeing here, especially with this massive rip higher. And why it's not wise to short into such a squeeze, but wait for clearer signs to happen. Again, probably you're not yet short based on what I just presented. If you're planning to go for a longer pull in lower, again, I'd favor a short below the lows here, which is very, very far away, to be honest. So a switch here in terms of the overall psychology in the market probably is to be seen below 15,100. Then things get interesting, because this is on average the price which was paid from market participants on the Fed itself. We are then below the price from the Fed, below the price which was on average price paid yesterday. And if we drop these levels and these market participants look at the prolonged weekend, Juneteenth, well, they're probably dumping their position, taking chips off the table, and then we get a cascade lower. But this is, again, we have to wait if we get to see that. So right now, at least there's not as aggressive buying taking place as it was yesterday. So we are dropping here right from 280. We are dropping below 150, 130 points. And now we're bouncing only 20, 30 points. It's not that much. Let's see if buyers can regain control. Right now, sellers are in control. And if we continue to drop lower, well, probably it's the start of something bigger in terms of a corrective move. But right here, right now, careful, very, very, very careful. And that's it from my end. So I hope you enjoyed the webinar. And let me, by the way, switch back here to the presentation. And regarding the contact details from Admirals, if you have any questions, please feel free to reach out to Admiral Markets directly. Contact their client support, ask your questions. If you have questions and you're watching this recording now on YouTube, ask them in the comment section. I'd be more than happy to help and answer them. And something else, happy trading. Watch your stops. Talk to you again next week. I really look forward to it. All the best. See you. Bye-bye.